Welcome to the daily update, where I'll go over the action in the market for Friday, December 8th, and then we'll see how things look for Monday, December 11th. The market reacted fairly positively to the employment situation report. Unfortunately, we haven't really broke out to the upside yet. We're just getting a little bit higher up into the range that we've been in for a while. We're still looking somewhat overbought, a little overextended. There are always some warning signs that we need to be aware of and things that are not really coming along for the ride. Not saying that that's going to turn things negative, but it is something that suggests that maybe things aren't as strong as we hoped they would be, but I'll go back through and explain those things. So let's talk about what happened. Right at the open, we had a lower open down below the daily pivot. The employment situation report came in pretty hot, and the initial reaction was interest rates went up, futures went down. So that produced the lower open below the daily pivot at 45.81. And then as the day went on, we were really choppy. We climbed above the unchanged level. We got to R1 at 45.96, and then we hit resistance at R2 at 46.06, which is just about the high point that we've been dealing with. Then as the day went on, we fell back below R1, down below the unchanged level, and we found support at the daily pivot. Very choppy. Then we rebounded back up above the unchanged level. We got above R1, back up to R2, and then we closed slightly below R2. So we were up 0.41%, and we're not seeing huge percentage moves on a closing basis. Typically, for the last week or so, they've all been under 1%, either up or down. We're seeing a lot of choppiness in the intraday action, though. We were below average with volume, which is strange because the employment situation report is very big. Volume was healthy, but it wasn't above average for what we would normally expect. We are still positive. We're dealing with an overbought condition, and we've been dealing with an overbought condition now for quite a while. But as with any extreme case, either positive or negative, these things can still run for a while before they finally exhaust themselves. But we haven't really gone into new territory yet, at least on this last little run that we've had. And inflation, interest rates, growth concerns, we're going to have a Fed meeting coming up in the upcoming week. What are they going to say when they release the results of the rate decision? And then, of course, we're keeping an eye on the geopolitical events, and that can always escalate things and have some impact on the markets. So some comments. We did close above 4,600, not very far, but the fact that we've regained that level is seen as at least psychologically positive. The mega caps did perform well in Friday's session. Oil closed up. We're back above 70 now at $71.18. This is interesting. The parabolic SAR, after being negative for 2 days, and usually it doesn't flip-flop back and forth that much, it's now switched back to being positive, and I'll show you that chart. So on a short-term basis, we still have our short-term ADX, which is well above 40 and not really showing any signs of rolling over yet. The Williams percent are the CCI 14, now to be joined by the 20. The stochastics chart, the PMO oscillator, the slope oscillator, which is actually declining, but it's still extreme positive, and then the VIX based on 9 periods. Intermediate term, we're getting up into that +3 standard deviations area now, so that's a little extreme. The Arun indicator, which was starting to come back down, has now gone back up and looking rather extreme. The PMO studies, the Sean trend meter is now back on the list. The NASDAQ 100 bullish percent index, that's still extreme. And then the new high, new low study for the S&P 500 based on 10 periods. We're still dealing with this same scenario that we have been now for a number of months, that the Fed is keeping rates higher for longer. We've been dealing with that. The market knows that. The Fed have said that is what they're going to do. What we're waiting to see to happen is, okay, with this strong employment report, that kind of throws this Goldilocks idea behind the economy into check. And maybe not at the next meeting, but somewhere down the road, the Fed may have to entertain the idea of keeping rates not only where they're at, but possibly even raising them. We'll have to see what is the trend going forward. There was this idea that possibly in March, the market was thinking that maybe the Fed will start to cut rates at that point. That's pretty much been taken off the table now. If we're looking at any kind of rate cuts, they're pricing that in around the May area. Of course, we keep an eye on what's going on with Israel, oil prices, and then earnings as they are released. The dollar was up because when you have interest rates going up, that means it costs more to get dollars. And so the dollar tends to go up in value. And interest rates were also up because of the stronger than expected economic report that came out. The 10 to the 2 and the 10 to the 3 month are still inverted. Sentiment is positive. We had been at 64. We ticked back up to 68. And our trend is still positive. The ADX is above its moving average. Both are above 20. The intermediate term ADX is getting closer to that 40 level. We want to keep an eye on that. With the update, our bias is positive, and I've changed our momentum from being mixed to positive. Until we can really break out of this range that we're in, it's like we've been bouncing to the top, then bouncing to the bottom, and bouncing back up. So I'm keeping it at mixed for right now. The reports that came out, we did have non-farm payrolls, and man, the market was just all excited about this, either positive or negative. They came in at 199,000. That's much greater than the 175,000 that they had expected. Last time we had an increase of 150,000. The non-farm payrolls came in actually less than expected at 150,000. They had expected 155,000, but way up from the 85,000 that we saw last time. The average hourly earnings, this is more inflationary, and when the market's able to dig into this, and I understand there were some problems with the website that was reporting this information, and that kind of delayed some of the reaction. But the earnings came in up 0.4%, double what they had expected. They thought it would be up 0.2%. Last time it was up 2%, 0.2%. The average work week came in at 34.4. That's up from 34.3. My goodness, to imagine a 34-hour work week. Last time it did come in at 34.3. The headline number and what all the politicians are going to dance around if they're positive on things. A lot of folks don't really pay attention to the unemployment rate because a number of years back it was calculated differently, and there's so much manipulation that goes on with it that can we really trust it? But that's that way with a lot of the reports that we get, but still the market and the media and everybody reacts to it anyway. It came in at 3.7%, down from the 3.9% that we saw last time. And we also had a reading of 3.9% last time. The consumer sentiment index came in at 69.4. That was stronger than expected at 62.6. Last time it was at 61.3. If you look back a year ago, we were at 59.8. Here are some charts. These are the non-farm payroll changes from month over month. And I don't have the line chart here because it's still so skewed from the COVID plunge. The chart is virtually useless, but we did have a tick up from what we saw last month. Then when we look at the average hourly earnings, they are declining overall, but they did increase in this latest reading. But when you look at it on a year-over-year basis, it is still going down somewhat. Here's the unemployment rate, which had been at 3.9%. Now it's at 3.7%. Here's everything taken together, where in Thursday's session, we had the initial jobless claims, which did go down. That's the red line. We're seeing a little bit of a turn down with the continuing claims, and now we're seeing a tick down a little bit here with the unemployment rate. Then looking at consumer sentiment, where the blue line is the total reading, and that's what we show on the chart. The expectations looking forward are showing some improvement. That's the yellow line, and how people are feeling right now is the purple line, and that's also showing some improvement. Then we look at the 10-year yield. It's currently at 4.25%. It's still above that 4.02% that we've been waiting to see. Can interest rates eventually work their way down below that level? Here's looking at some Fed figures. I usually only go over this in the weekly video, but because we have a Fed meeting coming up, the announcement will be made on Wednesday. I wanted to start including that right now. So as of right now, there's a 98 0.4% chance that they're going to leave rates unchanged. Almost a certain thing for right now. Here's the change where we really haven't seen all that much, where the dark blue area, that's the current reading. Then we look back a day ago, a week ago, and a month ago. Looking at our intraday chart where we were just all over the place. We gapped lower and then initially came back up above the daily pivot, the unchanged level, got above R1. We hit resistance right at R2 and then came back down below R1, below the unchanged level. And then we set some kind of support again at the daily pivot. Then when the professionals came in and started to take over, then we saw more of a systematic rise. Back above R1, we got up to R2, went above it a little bit, but then ended up closing down slightly below it. Here's the intraday chart where we were more positive, and then the reports came out and we shifted more negative. But then right after the open, that's when we saw the run up, the fallback, and then the advancing that we saw. And then as we closed for the weekend, we were up just slightly with the futures. We're seeing growth and value more on the same pace right now. They were both up, both the green line and the red line. I'm sorry, the blue line and the red line. Yes, I do know my colors. We were actually down just a little bit. This is one of those areas of weakness that we're not really seeing this coming along, at least on a consistent basis. When we look at the growth to value ratio for the S&P, it actually ended up closing down when we look at this intraday. Here's an end of day chart where growth did underperform value for the large caps, the mid caps, as well as the small caps, even though everything was up. This area in the middle are the ETFs that go with each one of these different parts of the market. And this is another little warning sign here. We're continuing to fall on an end of day basis when we look at the ratio from growth to value for the S&P. Discretionary is looking a little better though, so this is positive. When we look at the bottom with the ratio between discretionary and staples, we are seeing discretionary starting to outperform staples. Keeping an eye on our trend, we're getting close to that 40 level. We're just below it with the ADX. We're above the moving average, so we are in a trending environment. The green line is on top and it turned back up slightly in Friday's session where the red line continues to decline. On a short-term basis, though, we're just going up and up and up. We haven't had this high of a reading, at least in the memory of this chart. With the ADX above the moving average, the green line is also on top. So this is looking rather overextended. With volume, we're pretty much at the average. We were a little bit below. We've been a little bit above over the last few trading sessions, so we're just about at the midpoint. Keeping an eye on sentiment, we're still wondering, are we in this period now where the VIX has a tendency to chop around? This is the average from 1990 up to 2020. And if this does start to fall, that may mean that stocks are going up. We look at the Ulcer Index, which is another sentiment gauge where it flattened out a little bit. It's well below its moving average. And again, just suggesting there's not a lot of fear in the market. We did decline with the VIX, looking at the line chart as well as the bar chart, and the VIX is getting to a very low reading right now. And with the update, we did see the volatility of the VIX decrease with the bar chart as well as the line chart. The VIX to VVIX ratio, this is still looking more positive. When we look at the longer-term moving average, it's continuing to decline. Then the VIX to the 3-month average of the VIX is also declining. That's longer-term positive. The VIX to move ratio continues to be very low, and that tends to be more positive for stocks. Here's the one-day equity put call ratio where it turned down with the up day. We're still ticking back up just a little bit with our 5 period. I wouldn't necessarily take that as negative at this point. It's just saving us from getting to a real extreme reading very fast, even though we've been chopping more or less sideways with price. Longer term, we did come down almost to this extreme level and we're going back up just slightly. We look at the longer term 253 period study that we have here. It's continuing to decline. That's long-term positive. We were pretty much flat with this one fear gauge and we declined slightly with our other fear gauge that we look at. So we're seeing more uniformity with sentiment right now, and it tends to be quite positive. Here's another sentiment gauge that we look at. We're seeing a bit of an improvement with our risk on to risk off ratio. That is starting to go up. We see a little more of an advance here. We could start to count this as an overall uptrend. And then I should have included this earlier. This is consumer sentiment. That's the blue line showing how it ticked up to 69.4. We also plot the 2-year treasury yield on here where it's been coming down slightly. But as we've seen over the last few years, there's a really wide spread between the red line and the blue line. In a good environment, like we saw from about 2011 up to 2018 or so, these have a tendency to move in the same direction, and they've actually been moving more in the opposite direction the last few years. Looking at our studies where we did see an improvement with the advanced decline line based on price and volume, we're not really breaking out that much with our 5-period or 10-period moving average of the new highs, new lows, but we are showing a lot more new highs now, not really an expansion of any new lows. We go up, and then as the market goes sideways, these start to trail off, which is causing our other readings to go pretty much sideways. We are positive with the advanced decline ratio. We're also positive with the accumulation distribution. And the Chaikin money flow is showing some improvement. The red line is starting to turn back up. That is also positive. And when we look at the cumulative advanced decline line for the NYSE, it did have an up day. We're not quite ready to break out above this previous high yet. Our regular advanced decline line for the NYSE is showing some improvement, and we're above the moving averages with this other NYSE advanced decline line study that we look at. So when we take this together, the common stock, we are seeing some improvement with the advanced decline line. We were up with the S&P, mid caps, and small caps. Looking at our daily chart, where we're just coming into the underside of this resistance, we're still dealing with this previous high set back in July, on July 31st. We're just about at that level now. Can we break above it, or is this going to provide some kind of overhead resistance and push us back down at a minimum back into this channel? And then if we continue to fall, start to turn things more negative. We're not seeing that yet. We just want to be mentally prepared for that. On the bottom, we see where volume was just slightly below the average. The Williams percent R is still extreme positive, and the CCI 14 as well as the CCI 20 are also looking extreme positive. The force index is showing some improvement. We've come back up to the midpoint. So it's not full-blown positive yet, but it is above zero and green, so that's positive. If we can get above the midpoint and see the midpoint turn back up, that would be even more positive. In the short term, our stochastics are extreme. We're turning back up and not quite extreme yet. In the intermediate term, we're still flat with the long-term stochastics. And we're coming back up into the +3 area of our standard deviations chart, but we camped here for quite a while. If we can continue to go sideways, one positive thing that may develop is that these lines may continue to go up and not give us such an extreme reading. Intermediate term, we're turning back up with the balance of power. We're above the midpoint. That is positive. The go, no-go system has the darker blue bars, which are positive. We're still at the coming up to the blue line of the highest high value. The midpoint continues to advance, and the red line is also starting to come back up. This is looking more positive. But we look at the TTM squeeze. It's positive because it's blue, but it has been going down ever since we had this extreme positive reading. You could suggest that there's a positive divergence here. We've been going sideways with price as this indicator has been coming down. Looking at the ease of movement, we're turning back up just slightly and we're above zero, so that is positive. And here's the Arun, where we were getting an extreme reading. We fell back a little bit. With Friday's advance, we're seeing the green line going back up as the red line is flattening at the bottom. So we're seeing our oscillators start to get extreme positive again. This is encouraging too. The summation index based on price is advancing. We were starting to come down based on volume, and that sometimes can give us a warning sign. But this time, we've now been able to turn back up. However, we're coming back to this previous high here, which may act as overhead resistance. When we look at the NYSE summation index based on price and volume, they are both advancing. That's a broader measure. But here's a warning sign. We are declining with the Swenlin trading oscillator based on price and volume. And sometimes this can be a leading indicator too, but we don't want to take that for granted. It's also led us astray from time to time. Looking at the PMO, we're still rolling over, but we haven't crossed over negative yet, and we're at this red line, which is an extreme reading. We're rolling over a bit based on price and volume, but for right now, still positive. We're no longer extreme positive with the PMOs that are rising. The buy signals are starting to come down after being extreme. We're still extreme with the PMOs that are above zero, even though this reading was flat. And we've actually switched over to positive now with the Elder's Impulse system for the S&P. We spent a number of days being blue. We've now switched over to green. We'll have to see. Are we going to be able to get beyond this previous high now, or are we going to see some more downward to sideways action? And here's the interesting thing. This is the first time that I can recall that we only saw a parabolic reading that lasted 2 days. We had the dots on top. Well, with the upward movement on Friday, the dot is now underneath. That's positive. The slope oscillator continues to decline. It's positive, but we're still above this green line, and it's extreme positive. And the MACD is rolled over below its moving average, but if we see some follow through, it could turn back up. It's trying to turn up after Friday's session. So looking at all of our oscillators, we're getting a bit of a mixed picture here. The slope continues to decline. The TSI is pretty much on top of its moving average, slightly negative with the MACD. We're still slightly positive with the PMO. We're crossing over negative with the PPO. The TRIX is rolling over, but has not crossed below its moving average, where the KST has crossed below its moving average. So a real mixed picture right now. We're still above all of the plotted moving averages, though, and these are showing some improvement. The bullish percent index still not giving us an extreme reading. We're just barely below this 80 or I think 70 level right now. We're actually just a little bit above it, but this has actually been hanging in there pretty solid lately. And with the NYSE bullish percent index, we were sideways. We ticked up just a little bit in Friday's session. The NASDAQ 100 bullish percent index is giving us an extreme positive reading, but it did turn up. Now, it could go higher than this, but this is something we want to be aware of. The Chaikin oscillator is turning back up and is above zero. That's positive. The money flow is pretty much flat to slightly increasing, so we're above 50. That's positive. And the ultimate oscillator is above 50 and advancing. That's positive. We're seeing a little bit of a turn up here now with the vortex on the green line. That could be more positive. If we do see some weakness and drop below this one level, that would turn things a little bit more negative, even though the lines may not have crossed at that point. Looking at the RSI 14, we're just barely below being extreme positive, where the RSI 9 is now breaking above 70. On balance volume continues to be positive and is above the advancing moving average. We saw a little bit of an improvement with our 200-day moving average study and a little less of an improvement with our 50-period moving average study. Keeping an eye on where we're at, we're coming back up and now possibly testing this July 31st high, but we haven't really broken above that yet. Looking at the trend, we are showing some improvement here with the Heikin Ashi. We're seeing more open candles now, and we're more positive with the Kegi chart. The Renko chart is positive, and we're looking more positive now with the 3-line break with an open candle or bar. Excuse me. I have one long-term chart to show you. This is a weekly chart of the S&P on top and the MACD on the bottom. We are looking more positive on a longer-term basis when we look at momentum. Keeping an eye on our indexes, the equal weight was up, but is still underperforming the S&P. And we came back up just a little bit with our ratio, where we had really been coming down as the mega cap saw some weakness and the broader market was picking up. Saw a little bit of a tick up as the mega caps had a good day on Friday. We were up with the Dow. We were actually down with the transports. This is another thing to be concerned about. We were also down with the utilities, which ends up being positive for stocks most of the time. And the transports continue to underperform the Dow. When we look at the ratio, we're going down. This is not encouraging on a short-term basis. We want this transports to S&P 500 ratio to go up. It's actually going down. The Dow is pretty much chopping sideways, also more or less range bound. And we continue to be neutral with the diamonds based on the Elder's Impulse system. We're also just coming into the upper range for the NASDAQ. We really haven't broken out yet. And with the NASDAQ 100, we also haven't broken above these previous either intraday highs or even closing highs yet. We are positive, though, with the QQQs when we look at the Elder's Impulse system. And we, on a momentum basis, we're showing some improvement, but we continue to be negative for the NASDAQ 100. The small caps are a little bit above R1, but we've been here before. The idea is, are we going to be able to break to the upside, or is this going to produce some overhead resistance and cause the small caps to fall back? Longer term, we continue to be in a downtrend. The Russell 2000 index, we're getting back above 70, so we're looking extreme with the RSI. We closed just about on the resistance level here. A close above this would be a lot more positive. Until we can decisively get above that, this should still be seen as overhead resistance. We also have a longer term downtrend, but shorter term, the MACD is suggesting momentum remains positive. We continue to be neutral for the small caps looking at the Elder's Impulse system. We have not been able to come back up to this pivot level for the mid caps, and we remain neutral for the mid caps looking at the Elder's Impulse system. We were up a little over 0.5% with the financial sector, so this is showing improvement. And the micro caps also were up over 1%, so they're breaking out a little bit above 100. They're getting above their 200-day moving average. If they could stay above that, eventually get this to a golden cross, that would help things quite a bit, but that's going to take some time to do. The FANG index was up almost 1%. We're coming back up into kind of the middle part of this recent range that we've been in. And we've not been able to create a new all-time high yet. This could be acting as overhead resistance. We want to close above this to turn more positive. The bank index, we did see a recent golden cross here, and it had a good day. It was up over 1% in Friday's session. The dollar was also up because interest rates were up. Even though it had been seeing some weakness here, it continues to be in a longer-term uptrend. Keeping an eye on bonds, we were up with the 10-year yield and down with the 10-year based on price. We're still out of whack here. When we take the 1 month and subtract the 3 month, we now get a result of 0.10. And then updating our growth to value ratios, we saw a bit of an improvement with the Qs to S&P, but we're not really breaking out yet. Discretionary is looking a little bit better and is above the moving average. And we saw a little bit of an improvement when we look at large cap growth versus large cap value. So we're seeing some improvement with the large caps. We're actually still below the moving average with the mid caps and the small caps. We're still pegged at the top with our 10-day average of the S&P 500 highs minus the lows. That, for right now, suggesting good momentum, but we've been chopping sideways. So there's not an awful lot of momentum in that. But the fact that this is really not falling off should be still taken as positive. And we're still above zero with our 5-period moving average of the highs minus the lows when we look at the broad market. And when we look at the 50-period moving average of the new highs, new lows for the S&P, we are continuing to advance. That's positive. Our indicator continues to be positive, and the red line continues to go higher. And we're wondering if we're topping out with the 2-year Treasury yield. It spiked up here and it's starting to come down. That may have given a little bit of support, not so much in Friday's session, but the overall trend of this chart. For this to continue to fall would generally be more positive for the S&P. And we saw the staples. We saw the staples to S&P 500 ratio declining, and that often gives good support to the S&P. I still haven't received the research yet from Tom Bowley. Hopefully I'll get that over the weekend. So what's our outlook for Monday? We're still dealing with earnings season. It's pretty much over now, but about the time we end one earnings season, we start the beginning of a new earnings season. So it's pretty much always happening. Keeping an eye on all the different geopolitical events, see if things develop over the weekend. There is the holiday period of Hanukkah in Israel. We'll have to see if that's going to cause any kind of escalation at all. The technicals are positive. We're back to just looking more overbought. We're not really showing any real weakness right now. There are warning signs that we need to pay attention to, but they're just warning signs for right now, and I'm still considering us to be more range-bound. Now we're even further at the top end of the range. We won't get any economic reports on Monday, and then keeping an eye on all the different geopolitical events. Here's the new calendar for the upcoming week. It's going to be a heavy week. We've got CPI coming out on Tuesday. We've got PPI on Wednesday. Then the Fed's going to make their announcement. We've got retail sales on Thursday. And then I think this is important, the industrial production and capacity utilization report. So it's a pretty heavy week as far as measuring inflation. Looking at seasonality for December 11th, we're neutral to negative with the Dow. We're neutral to positive with the S&P 500, and we're flat out positive with the NASDAQ. Now, we are coming into options expiration week, and we tend to be positive. We're up 69% of the time, and we're down 31% of the time. We're also wondering if the January effect is going to kick into gear. This tends to favor the small caps. This is a chart of the ratio of the small caps to the large caps based on the Russell indexes. And this is usually the period when we see some good growth in the small caps, but they're not really breaking out yet. And we still have a longer term downtrend. We will be on the 7th trading day of the month, where we're pretty much flat when we look at the green dashed line during a pre-election year. And we'll be on the 11th. This, according to Carson, from 1950 to 2022, this is when we might see a period of some weakness. So in the upcoming week, historically anyway, they don't necessarily see things remaining all that positive, but anything can always happen. We will be on Monday, and that tends to be the best day of the week in 2023 on a percentage basis. And now we're wondering, have we been able to get beyond this period now? The green line, according to the Stock Traders Almanac. Also, are we eventually getting beyond this other area, which may continue to be sideways for a little bit longer? This other chart doesn't really show as much sideways action, but we might see some strength before we end up seeing some weakness. Also, some strength before seeing some weakness on this chart. And we're wondering, are we finally getting beyond this early part of December based on the Carson research? And now will we see more positive seasonality? Then the equity clock chart, have we seen the pullback, or is that still to come before we see more positive seasonality later in the month? We just kind of have to guess for a number of different reasons. Number one, we see different things on different charts. Also, we've got this whole block of December. There's no real dates that are spread out here. Stock Traders Almanac does a good job, and Carson does some things. But charts like this, it's kind of ambiguous as to what days we're actually talking about. Looking at the Stock Traders Almanac statistics, we tend to be more positive seasonally for the NASDAQ, where we might see some weakness with the S&P, or we might be beyond that, where we see things turn more positive. So our scenarios, we're not going with the down one right now, even though we are showing a lot of overbought indications, and we are range bound. So if anything, if we fall, right now anyway, we may just fall to the lower end of that range. And I don't know if that's worth it enough to really take on any short positions. We are still looking positive because that's what our charts are suggesting, even though we are overbought and we are just at the upper end of the range. And because our ADX charts are suggesting that we are trending, we're not necessarily focusing on sideways patterns for right now. The warning signs, the risk on posture, we're back to looking a little bit better, but will we see any follow through with that? Our momentum oscillators are mixed, so you can take that as either positive or negative. The copy curve is negative, and I haven't been showing that chart. And the Russell, small caps, and mid caps continue to be in longer term downtrends. On the positive side, our daily special K chart is still positive. When we look at our equity put call ratios, we're still going down with the 5 period, even though we ticked up. We're wondering, are we getting to that extreme reading? Now, we could drop below that line without any problem. But when we get down to that level, a lot of times that will be close to signaling some kind of a top. Longer term, we're still looking more positive. And we're mixed when we look at all of our different oscillators. The parabolic SAR has now switched back to positive. The vortex is positive, but it is showing some signs of weakness. And the one that's hanging in there the most right now is the bullish percent index. It continues to be positive. Small and mid cap growth still continues to chop sideways, even though longer term it's still in an uptrend. And the financial sector is working off of a rather new upward trend. In our 50-period moving average study of the new highs, new lows, that's continuing to show improvement day after day right now. So our conclusion, we're positive, but we're overbought, and we're still stuck in this range. We can say that in the short term, and we're somewhat overbought in the intermediate term. I could have said we're range bound for the intermediate term, but until we deal with the short term, we can't really focus that much on the intermediate term. Where in the long term, we continue to be positive since we're above the 200-day simple moving average. Thank you. I really hope you found this helpful. I will be posting the weekly video, the intermarket analysis video, and the deep dive video over the weekend. So I hope you have a great weekend, and I will talk to you in the next video.